as well as the Prime Minister's Council expressing some sort of concern over the IIP data, and they were hopeful that for FY13 at least the GDP numbers for the country will creep back towards that 7.5% mark. Yesterday as well, we had Subir Gokaran, the Deputy Governor of Reserve Bank of India, talking about how we might just see yet another a round of easing come in. We might see another round of a CRR rate cut. So do remember, CRR is of course, the reserve requirements that banks have to hold with the central bank, that is the Reserve Bank of India. So given the tight sort of liquidity conditions that we are grappling with right now, Subir Gokaran was mentioning that we might just see some bit of easing come in there if the conditions continue to be tight. But for now, we've got visuals of Dr. Rangarajan, to whom we'll be cutting across very soon and very shortly, and get you his views on the discussion that's going to commence very, very shortly.
Sure, Megha. One thing we also need to keep an eye out on, come next Friday, that's the 29th of February, we also will be getting our GDP numbers. And just to add on to what you were saying earlier, you did have the Prime Minister's Economic Advisory Council. There is an expectation that they will project a GDP growth rate of 7.5%. Let's cut across.
As you know, the Economic Advisory Council brings out every year two documents. One is known as the Outlook, and the other is a review of the economy. Outlook comes sometime in July of each year, and the review comes sometime in January, February. What we have indicated in the review for 2011-12 is our projection for the growth rate for 2011-12 and some initial or preliminary estimates for the growth of 2012-13. The rate of growth in 2011-12, the rate of growth in 2011-12 is now estimated at 7.1%, which is a shade higher than the projection of 6.9% as per the advanced estimate of CSO. The Council projects a slightly higher growth for agriculture and construction than the advanced estimates. The advanced estimate had indicated 2.5% as a growth rate for agriculture. We believe that the growth rate in agriculture will be 3%. In the case of construction, the advanced estimate indicated a growth rate of 4.8. We feel that the growth rate in construction will be 6.2. As far as the other sectors of the economy are concerned, our growth rates are more or less the same as the growth rates indicated by the CSO. Therefore, overall, we project a growth rate for 2011-12 of 7.1%, which is a shade higher than the projection of 6.9% by the CSO. We know that the international economic conditions are quite tight. The European situation is still in a fluid stage, but it is hoped that Eurozone countries will soon find a solution to their problems. Germany is now willing to come forward to support any program which will provide relief to those countries which are in a difficult situation. The US economy will do slightly better than the European economy. However, the overall situation, the external situation, will still be tight. It is expected, as far as the coming year is concerned, that there will be no shocks. But by and large, the difficult situation on the external front must be taken into account while making any projection for the growth. Structurally, if you see what comes out is that the investment rate has been coming down since the crisis year. After the crisis, output picked up quite quickly. As you know, the year after the crisis, the Indian economy grew by 8%, which has now been revised to 8.4%. And in the following year also, the economy grew by 8.4%. But investment did not pick up. And the investment rate in 2007-8, that was the year prior to the crisis, was 38.1%, and it came down to 35.3% in 2011-12. But more importantly, if you look at gross fixed capital formation, it came down from 32.9% of the GDP in 2007-8 to 29.3% in 2011-12, a fairly sharp decline of almost 4 percentage points over the last 4 years. The domestic savings rate has also come down from 36.8% in 2007-8 to 31.6% in 2011-12. Therefore, one factor that we need to take into account is the decline in the investment activity in the economy. Coming back to 2011-12, we estimate, as I mentioned earlier, the agricultural growth rate will be 3% during the year. This will come on top of a fairly substantial growth rate in the previous year. All indications are that we will have a record food grain output during this year of something like 250.4 million tons. And the horticulture and animal husbandry will also show a strong growth. So taking all these factors into account, we project a growth rate of 3% for agriculture in 2011-12. As far as mining and quarrying sector is concerned, there the output growth has been weak. This has been due to a number of factors: weak coal output, restrictions imposed on the output of iron ore in some of the states, a decline in natural gas production, and negative growth rate in crude oil output. All of this taken together will result in a negative growth rate of 2.2% for the mining and quarrying sector is concerned. This is the same number as has been indicated by the advanced estimate. Electricity will do well, and it has performed well, and it is expected to grow at 8.3% during 2011-12. As we all know, manufacturing has not been doing well during the current year. After doing reasonably well in the first quarter, manufacturing started declining in the second and in the third quarters. In October, there was a decline in the manufacturing output, but there was a strong pickup in November, but once again in December, the growth rate was again very low, 1.8%. Therefore, the manufacturing sector has not been doing well, but we expect a pickup in the months of January, February and March. Nevertheless, the overall growth rate in manufacturing will be only around 3.9%. As far as construction is concerned, it has not been doing extremely well, but has not been bad. But there has been some pickup in the production of cement and construction steel, which may indicate a pickup in the construction sector, and that is why we have estimated the growth rate in the construction sector at 6.2%. There has been a strong growth in the services sector, and it will continue to do well, clocking a growth rate of 9.4% during 2011-12. So these are the sectoral growth rates for agriculture, mining and quarrying, manufacturing, construction, and the services sector. For during the year, the balance of payment situation has been somewhat difficult. And the Reserve Bank of India has already published the BOP data for the first half of the year, and it indicates a current account deficit of 3.6% annualized for the first half of the year. As you all know, that the third quarter of the year, that is the quarter ending December 2011, saw a sharp depreciation in the value of the rupee. That is because of the mismatch between the current account deficit and the capital flows. Coming back to the trade deficit, you will find that the trade deficit has been quite strong. It is now estimated at about 9.3% of the GDP, which will be more or less equivalent to $175 billion in round number, comprised of an export of $304 billion and import of $479 billion. Apart from the fact that nearly 1/3 of the imports is crude oil imports, another factor that needs to be taken into account has been the very high import of gold during this year. We estimate now that the gold import for the year as a whole will be something in the region of $58 billion. This is a substantially high level of import of gold. In the previous year, the import of gold was only $33 billion. Part of the higher level of import of gold could be due to the fact that gold is being treated as a hedge against inflation, as a hedge against other alternative financial assets which are not as attractive in the context of inflation. Therefore, there has been an extraordinarily large increase in the gold import, which has also resulted in the trade deficit going up to the $175 billion, which constitutes 9.3% of the GDP. But the services sector are doing reasonably well, and the services sector taken together, including the private remittances, will contribute something like 5.7% of the GDP. That is, a surplus on the invisible account will be 5.7%, giving you the overall current account deficit of 3.6%. The high level of current account deficit would not cause much concern if the capital flows are adequate to cover the current account deficit. During the year, as I mentioned earlier, in the quarter ending December 2011, the extent of the capital flows was not adequate, and that is why we saw a depreciation of the rupee. But the capital flows have subsequently picked up. There are 3 or 4 important channels through which capital flows into the country. One is a foreign direct investment, the other is a portfolio capital, the third is the loans, and the fourth is the NRI deposits. FDI, that is foreign direct investment, will do well during the current year. We estimate actually the capital inflow through foreign direct investment at $20.6 billion. This is significantly higher than the $7.7 billion that we got during last year. The portfolio flows will be modest. As I mentioned earlier, that there were some outflows in the quarter ending December, but there has been some strong inflows of FII investment in equity in the month of January. Taking all of that into account, we think that the portfolio inflows, or the equity inflows, will be only about $4.9 billion during the year. This will be a substantial climb down from something like $30.8 billion of the previous year. The debt flows during the year have been very strong. We estimate the overall inflow under the heading of loan at $36 billion. Part of it will be external commercial borrowing. Part of it will also be FII investment in debt instruments, which has also been very strong. NRI deposits have also been very strong. So in all, we expect a capital inflow of something of the order of $72.9 billion. After covering the current account deficit, it will lead to an addition to the reserves of by about $1 billion. Therefore, that is the status of the current account and the balance of payments as far as this current year is concerned. We certainly, I will emphasize that point a little later, we should certainly work towards moderating the current account deficit. In a world in which there is a lot of uncertainty, I think it is best to reduce the current account deficit over the medium term. But at the same time, we also need to encourage the capital flows which are badly needed to finance the current account deficit. As far as inflation is concerned, as we know that there has been a decline in the headline inflation, and more particularly the food inflation since November 2011. The headline inflation, according to the WPI index, has come down to 6.5% in January 2012, and it's our estimate that it will continue to remain more or less at this level till March 2012. Policies, both monetary and public and other policies, have helped to moderate inflation. But sustained high food prices have resulted in the inflation getting generalized. That is why you find year-on-year inflation for manufactured goods rose from 5% in September 2010 to almost 8% in September and October 2011. Therefore, even in January 2012, while food inflation has become negative, the non-food manufacturing inflation still remains at a high level, and therefore we need to watch for what is happening to the non-food manufacturing inflation in the coming months. As far as the government finances are concerned, there is a detailed chapter in the report. We do find that the revenues, particularly on the direct side, are not growing at the rate at which it was envisaged in the budget, and the expenditures, more particularly under the caption of subsidies, are increasing. As a consequence, the budget deficit is going to be higher than what was indicated in the budget, which was 4.6% of the GDP. The chapter does indicate, I will come back to it a little later, some directions in which we need to move as far as the government finances are concerned in the coming years. But the high level of budget deficit, the fiscal deficit, is a matter of concern, and government must strive to contain and improve the efficacy of subsidies. So this is as far as the current year 2011 are concerned. Let me now indicate a few details for 2012-13. These are preliminary estimates at this particular point, but when we bring out the outlook in July, we will have a more detailed review of what will happen in 2012-13. We project a growth rate of 7.5 to 8% for 2012-13. Mining and manufacturing are expected to do better than 2012-13. That could be a substantial improvement. We think that the mining sector will grow by 6% during 2012-13, and the manufacturing sector at 7.5%. I will give you presently the reasons why we feel that the manufacturing sector may grow at 7.5%. Inflationary pressures will continue to ease through 2012-13 and will remain around 5 to 6% for the year. As far as the balance of payments is concerned, the current account deficit will remain at around 3% of the GDP. These are the salient numbers as far as 2012-13 are concerned. But what are the important issues during 2012-13 which must be addressed and which will help the economy to grow at the rate that we have indicated? As far as manufacturing is concerned, it will gain because of the fact of the moderation of inflation during the year. This could also lead to some changes in monetary policy as and when the headline inflation and core inflation show definite signs of decline. Second, we think that there will be a concerted effort made to ensure that there is adequate capacity creation in important infrastructure sectors such as coal, power, roads and railways. It is imperative, as I mentioned earlier, to bring up the investment level to a higher position. We have seen a decline in investment and more particularly gross fixed capital formation in recent years. And therefore, one of the most important things that requires to be done is to raise the level of investment. And in this, many of the key infrastructure sectors also fall within the purview or within the domain of the public sector, such as coal, power, railways. And therefore, a greater effort must be made to increase the investment in the infrastructure for capacity creation, as well as operational performance in coal, power, roads, and railways. The second, as far as inflation is concerned, as I mentioned that during the year 2012-13, the inflation rate may remain between 5 and 6%. But I believe that what we really need to do is to focus attention on agricultural production and productivity, and at the same time, as we have seen in the recent period, particularly last year, that the extraordinary increase in the prices of vegetables has been due to the archaic marketing arrangements that we have. And therefore, we also need to focus attention on the marketing. Now, it will be necessary during the year 2012-13 to make some adjustments on diesel prices in a phased manner. We have not done this for quite some time, and the international crude prices have gone up, and therefore the oil marketing companies are incurring or facing a difficult situation. It is not possible for us to subsidize this sector beyond a minimal level, and therefore some adjustment in the pricing of refined petroleum products during the year will have to take place. Now, as and when they take place, they will have some immediate impact upon headline inflation, but over the medium term, that is the appropriate thing to do. As far as the BOP is concerned, as I mentioned earlier, that the current account deficit during the year will be about 3% of the GDP. We expect that gold import next year will be about $38 billion, down from the $58 billion that we spent this year on gold imports. Now, that is also conditional upon two things: inflation coming down and staying at a more reasonable level. And second, we have also suggested elsewhere that it is important that the rate of return on financial assets are attractive enough so that they are weaned away from importing gold from a purely asset point of view. Therefore, we should, over the medium term, try and get the current account deficit down to something like 2 to 2.5% of the GDP. As I mentioned earlier, so far we have not had any difficulty in financing the current account deficit. The capital flows have been adequate, but in the current year, as I mentioned earlier, the capital flows may be just adequate to cover the current account deficit. Therefore, in an uncertain world, it is important that we also take efforts to contain the current account deficit at more reasonable level. In fact, if the current account deficit exceeds something like 2 to 2.5% of the GDP, investors' perception also changes, and therefore we need to take that into account. At the same time, I must say that we must be proactive in attracting capital flows. Capital flows have their own dynamics. They flow towards countries which grow fast in an environment of a reasonable fiscal deficit and moderate inflation. These are also our goals, and therefore we should not decry capital flows. We must encourage the capital inflows which are badly needed to cover the current account deficit. Thirdly, on the exchange rate, we have indicated our views. We certainly think that excessive appreciation of the rupee may not be good, and it may not necessarily promote exports. But at the same time, we need to be conscious of the impact of depreciation on capital inflows also. Therefore, our policy towards exchange rate must be guided by concerns of both current and capital accounts. We must strike a balance, because a steadily depreciating currency will not attract capital flows. Therefore, we should not enter into that kind of a phase. But at the same time, we really need to ensure that there is no excessive appreciation of the currency. Finally, to the government finances, we have advocated that we must go back as soon as possible to the pre-crisis level of tax GDP ratio. The demands on the government for various kinds of expenditures is increasing. There are many social welfare schemes that are on the anvil of the government. And therefore, if we have to work towards a moderate level of fiscal deficit, it is important that we also raise the tax GDP ratio as soon as possible to the pre-crisis level. Second, I think we should lay out a roadmap for fiscal consolidation, for bringing down the fiscal deficit. The roadmap laid out by the 13th Finance Commission is no longer valid because according to the roadmap of the 13th Finance Commission, we should come down to 4.1% of the GDP. The fiscal deficit should come down to 4.1% of the GDP in the next year, which is almost impossible to do. But nevertheless, it is important that a good roadmap for fiscal consolidation is drawn up by the government. The report also gives some detailed analysis of what needs to be done on GST and what needs to be done on the services tax. Therefore, to conclude, let me say that we expect in 2012-13 the growth rate to be between 7.5 and 8%. We expect manufacturing to pick up. In assessing the growth prospects of the economy forward, we should say that we might be able to achieve a growth rate close to 8% on our own steam. But for us to achieve and to get back to the 9% rate of growth of the economy, we also need a more hospitable world environment. And therefore, I believe that for the next 1 or 2 years, until the world situation clears, we should be able to grow at 8%, provided, as I mentioned earlier, we take some of the corrective actions. But if the world economic situation turns more hospitable, I think we might be able to achieve even a higher growth. I think that is, in substance, what the review has talked about. And do you want to say anything else? We will wait then. Okay. All right. We will take the questions if you have.
Thank you very much, sir. The House is now open for questions. Yes, please, Shishir.
What are the corrective